You guys know about DSCR loans? Well, guys, today, ladies and gentlemen, I am here with the man, the myth, the legend, Mr. Josh with CrossCountry Mortgage. We're going to be talking about that. As you guys know, I wrote this book and I love investing. So Josh, before we get into it, let's hear your story.
Yeah, so I've been in the industry for a little over 15 years. Actually, I got in about 2008. Started at Wells Fargo Financial, the boiler room of Wells Fargo, doing subprime stuff. Well, obviously, they got shut down very quickly, and I'm kind of glad it did, because we got converted to Wells Fargo Home Mortgage, and whereas in loss mitigation, we basically created the entire loss mitigation department for Wells Fargo, doing loan modifications on bad loans, short sales, foreclosures, things like that. Well, during that time, I got very adept at reading tax returns and figuring out ways to get people qualified for mortgages that normally wouldn't be able to get qualified. I knew a lot of these people had money, but they obviously weren't showing it on their tax returns. So I had to get very skilled at figuring out where the money was. So eventually I ended up getting recruited out of Wells Fargo to a private mortgage bank. Been in this industry ever since. Came to CrossCountry, started my own branch here, the Gullick Group, about 3 years ago. Was working in a pod, a team. So I've been running a team for a long time, but in 2022, obviously the paradigm shifted, the game changed, rates went up, we had to figure out something new. So what we did to adjust and kind of ameliorate our process was to figure out how we could help our partner agents do better. So as you know, we have a full-on marketing team. We've got pretty much every loan product on the planet, which is one of the other reasons I came to CrossCountry. Say we got more loan products than the Cheesecake Factory has menu items. So one of those we'll talk about, the DSCR loan. But since we really started implementing implementing items that our real estate agents don't have the capacity to do ourselves. So we basically say, hey, what do you want to do? You tell us what you can't do, what you don't have time to do, and we will do it all for you. We'll tell you the minimum things that we need to make that happen, and we just make it happen for you. So that's worked out very well. Last year we had a record year. I personally closed 108 million in loan volume. My team did 220 million combined. So it's working well. The market's shifting, but one of the big shifts was non-QM. So I generally stayed away from it for a long time because I was, again, adept at making income or appear out of thin air, not thin air, but when you got somebody with 25 businesses and 14 properties, they're hiding stuff. You pull up to my office in a Bentley and your tax return say you made negative $200,000. I know it's there, I just got to find it. Well, it's hard. I took the hard way around because non-QM loans for the longest time were, priced like hard money, but with 3 times the effort.
So let me stop you right there because my audience, some of them are very, very new. What's a non-QM? What's a DSCR? Just break it down like really, really easy for somebody to understand.
So non-QM or DSCR is actually a non-QM loan. So non-QM stands for non-qualified mortgage. Non-qualified does not mean you don't qualify for the mortgage or this is in no way tied to subprime loans. These are highly qualified mortgages. People have generally great credit. Good to great credit. They have enough money to put down. So usually putting at least 10% down, 15% down in a lot of cases. They are making money, but they just don't fit that box. So there's a certain box. That box, the CFPB calls ability to repay requirements, but a lot of people just don't fit into that really nice tight box. So we've got loans like bank statement only loans, which is a big one that we do. So somebody that, I'll give you an example. I've got a client who owns a grocery store. So grocery stores are notoriously high volume, low margin. So the guy was bringing in about $10 million on paper in gross sales. Net income after everything, after all expenses, but after obviously some other expenses that probably shouldn't have been in there was like 150,000. Well, I knew he could easily qualify, see what he's pulling in, his distributions, what he's actually taking in, could easily qualify for $1 million home. But on paper, he couldn't get anywhere close to that. So we've got a loan that just allows us to take a 50% expense factor. Now, I'm not going to let him buy a house that he would qualify for with $5 million because I'm not going to put him in that position. But that gave me the opportunity to get him into a home and actually a rate that was probably within 0.25% of a full traditional income qualifying loan. But he had talked to 4 other banks before he met me and nobody could do anything for him. So he was looking at hard money when he found an agent that was up in Northern California. She referred him to me, but the last one he was looking at was like 10.5%. like 3 points up front. We did him at, I want to say it was like sub 7% on a 30-year fixed.
Nice.
So that's one type. We also do a lot of loans that are just asset based. So if somebody doesn't have any traditional income sources, I would give you another prime example. We did 2 of these in the last 2 months, but people that are going to sell their property after they purchase a new property, they don't want to go contingent. As you know, contingent offers are not looked at as favorably as a non-contingent offer. They also knew that they wanted to put a large, so both people, coincidentally, 2 different areas, but both had the same goal, wanted to sell their property after, give themselves enough time to update it so they can get top dollar. And then once they sold it, they wanted to apply some of those proceeds to the balance to recast the payment or to lower the monthly payment so that they're not carrying a large payment moving forward. So one of the examples, guy was making, he had no traditional income. All of his income was based off of the return on his assets. So has about $5 million in assets. We're putting about $300,000 down on the purchase. Actually, no, $600,000. So $600,000 down on the purchase, $1.9 million loan amount. He was going to sell his property for like 2.3. He was going to apply 1.65 after the sale to the new loan. So what we did was, with those $5 million in assets, we subtracted the $600,000 he was using for the down payment. All the rest of the assets, we just divided that number by 84. That's income. So he easily qualified for the other property. Then when he sold the other property, which happened about 3 weeks ago, he called me. He said, I want to make a large payment. We worked out something with our servicing department so that he can ACH that big payment because he didn't want to send a big $1.6 million check in the mail. So he ACH'd the payment to our warehouse, and they applied that. So now his payment's back down to like $1,500 or whatever it was. We did an interest-only loan, so that recast by itself. But the reason we went interest-only was just because of that, because we wanted the payment to go down as soon as he applied the principal down. So
that's awesome. That's awesome, Josh. So, folks, one of the things that did catch my attention, I'm not sure if you saw that or heard that, I've dealt with a lot of lenders in my time, and some people tend to shop, but if they get declined like 4 different times, this speaks volume of what kind of lender you are. So what really is that really unique secret sauce that you have, why people should use Josh, the Gullick Group, CrossCountry Mortgage?
Well, there's a certain, I guess it takes a certain amount of loans to see angles that you might not see if you haven't run into a situation. I run into pretty much every situation. I've had mistakes, I've learned lessons, but I never make the same mistake twice. So I'll tell you, I'll tell you my failures. I have no problem doing that, but I remember vividly 2016, I didn't look at an appraisal. I'll be honest. I didn't look at the appraisal. I at least didn't search the appraisal for peeling and chipping paint. This is something that you guys may
FHA,
understand.
right?
No, it wasn't FHA.
It wasn't FHA.
That's why I didn't look for it.
Oh.
So if it was FHA, I would have looked for it. But the appraiser pointed out peeling and chipping paint on a conventional appraisal. Now, whether or not I should have been looking for that it's actually unquestionable. I should have been looking for it. I should see every angle, but I had a blind spot. And what did I end up doing? Well, I wasn't going to tell the person that, we need you to do all this extra work because it was my fault. So I got down to business, called my brother, called my dad. We literally went out and scraped this house, picked up all the paint. We picked up all the chip paint. We went and painted the entire house with kills just to get this loan done. So
I love it. Josh, you're my kind of guy. You see, guys, sometimes it's not a matter of what company, it's the individual loan officer, and if they're willing to go above and beyond. Because I remember, Josh, I did the same thing a while back where the appraiser called us out and wouldn't push the loan through. And I'm like, what will it take to fix it? It was like down a lot in South San Diego, you have those security bars without those quick releases, right? And that's a big no-no, especially with buyer. And so, guys, we're going to be doing more, I could tell. This is one real short episode that I wanted to do with Josh. But I'll tell you what, right there, that should tell you the level of professionalism, the just above and beyond attitude that you want to work with Josh. Now, like I said, I want to do a lot more with you, Josh. And to kind of sum it up, why DSCR now?
So DSCR, and I'll get into 2 different types of DSCR, but first, what is a DSCR loan? So DSCR just stands for debt service coverage ratio. So this has been a method for qualifying people on commercial properties for a long time. It's gained more popularity in residential mortgages. It is considered a business purpose loan, so it doesn't follow a lot of the same rules that we are required to follow for under Dodd-Frank. So it's only allowed on investment properties. So that's something that is really important if you're looking at a property, let's say a multi-unit, and you want to rent out those other units. It can't happen. I guess even more a more nuanced guideline is most DSCR lenders, including us, won't allow you to take proceeds from the sale of a property, like a primary residence, and then put that down on property, an investment property. You can't take loan proceeds out for a property you're going to move into. So you can't do a DSCR cash out loan, and you can do it on a refinance or a purchase, but you can't take cash out proceeds from using a DSCR loan to purchase a primary residence, because there's just that connection for primary residence. So it does have to strictly be business purpose. You're not supposed to move into that property ever. So whether you buy a commercial property under normal circumstances, you move into it 2 years later, even if you do a 1031 exchange, which I'm sure you will talk about more later, but in a future podcast. But the DSCR loan is strictly to get you to purchase or refinance a property, strictly using the rents that property generates. So you've got that debt service coverage ratio. That is a ratio, and the ratio is comparing the rents received, or the rents you would receive, to the monthly payment. We can generally qualify you. The general rules are about 1%, or it's like a 1.0 to a 1.25% DSCR. So, for example, if you had a 1.25 or 1 to 1.0 DSCR would be your payment is $3,000, and you're going to get $3,000 in rents. We don't have to dilute the rents by 25% for vacancy and maintenance like we would on a traditional loan. But if that debt services itself, we're good. Now, we actually have a program that doesn't have any debt service coverage ratio requirements, so there's no ratio. Now, those require more down, but the pricing is going to get better, the interest rate is going to get better, the better that property is cash flowing relative to the payment. So usually in San Diego, California, Southern California, especially the DSCR is difficult to debt service a property with less than 20% down, less than 25% down. That's where we can use something called a Airbnb rent, or we use AirDNA to determine some short-term rental amounts. So we'll run it through a system called AirDNA, which gives us the potential short-term rents from that property, and we can use that to debt service. So I'll give you an example there, because this is a unique product. I don't think very many people have it. We have it internally, but I had a client with a listing in Bay Park. The property was about a $2.1 million purchase price. Probably would have rented, I think, for $6,500 long term. No way that property would have debt serviced just on long term rents, but the short term rents through our DNA were showing something like $12,000 a month. So we were able to do a debt service coverage ratio based on the short term rents.
Nice.
But yeah, so that's really where that product comes into play, is when somebody can't qualify based on their income alone, but that property itself qualifies, that property itself can cash flow. We can do a loan without any outside income whatsoever. Also, another benefit is we can close that in an LLC. So, one of the big things for investors is if you're purchasing a bunch of investment properties, you're going to be limited to the number of finance investment properties. Usually 10 is the maximum number of finance properties before you're going to do this. So I'm doing one right now. I've got a client in Arizona. She owns, I want to say 25 properties, but she's at that 10 property mark.
Yeah.
We just did a purchase for her, a 3-unit property in Mission Beach about 6 months ago or so. We want to refinance that, but if we were to do one more loan, we're going to be over that 10 property threshold, and we're going to be limited to, I would say, some non-QM loans, but loans that are going to have a higher interest rate. So that DSCR loan, because we're closing in an LLC, does not count towards that property down. So it is not included in that property down.
Perfect.
So there's a lot of good uses for it. That's being one of them, because it doesn't include, it's not included in the property count. If somebody has a large real estate portfolio and they don't want any properties in their name, because a lot of property people will quitclaim or transfer the ownership of a property from their name to the LLC immediately after closing. So you can grant that property into the LLC, but it does have a short period, or you'll see the transfer records with that person's name. Now, some states have anonymity, where if it's in an LLC, I can't just go look up that LLC and who owns it. California is not one of them, but people are buying in Arizona, Texas, and other states. They don't want people knowing what their holdings are. So this gives them the option to close directly into the LLC so they can maintain that anonymity and protect those assets and limit liability to that specific asset so somebody's not coming after your 14 property portfolio. So that's another benefit there. But I would say the primary benefit that most of our clients are using it for is just they don't have other income sources, or their other income sources or other properties are cash flowing poorly on paper, which hopefully they should with depreciation and things like that. But they can buy a property, and as long as that property is a good investment, they qualify. And minimum credit score, we've got a minimum credit score of 660 in most cases. Obviously, the better the credit score, the better the interest rate. But one of the ones I'm doing right now, it's a low LTV, it's 60% loan to value, 40% down payment. It's a 6.625% rate. So, I mean, the rates are not bad at all.
That's awesome. That is awesome. Those are the two words you want to hear, guys. You qualify. So, Josh, this has been wonderful. Guys, like I said, if you really enjoyed this, you can see Josh is very unique. He's out of the box. He goes above and beyond. He really knows his stuff. And so connect. What's the best way to get a hold of you?
You can reach me at my cell phone. I'll give you my cell phone number. It's 619-495-9904. You can also reach me by email. So if I'm not answering my phone, if I'm on a call, which I'm always pretty much on a call all the time, but somebody will answer on my team and I'll call you right back. But if you don't want to, if you can't get a hold of me on the phone, then just email me at teamgullick@ccm.com. So that's all one word, team, GULLICK@ccm.com. And love to work with anybody you can send our way.
Perfect. Thank you so much, Josh. This was amazing. Guys, feel free to reach out to Josh. He knows his stuff. And let's buy some more investment property. See you guys later.